might as well have a good time.
That's what I say.
And yes, thankfully they are back in school. Mine are 4 and 7, and it's been a summer.
Oh yeah, you got the young ones, man. Oh, you got.
I got the young
man.
ones.
Yeah, you got.
I got the young ones.
I was talking to a friend of mine the other day. I was like, yeah, man, it's I was like, just wait till you get in the thick of it. He's like, I'm in the thick of it now. They're in kindergarten and 3rd grade. I was like, bro, I'm here to tell you that's not the thick. Middle school, high school, that's when it's really like, yeah.
My sisters are 9 and 11 years younger than. Oh, I mean,
They still listen to you.
They're well. We'll say that. We'll say on air that they do. Their murderous rage knows no bounds. But they are, for all that, excellent. And it's only a matter of time before they outsmart me and spit roast me. And matter of time is like days, not weeks.
Yeah. Yeah. I've resigned to that fact a long time ago.
Yeah, see, there you go. There you go. How do you feel about this reset in the markets today? I mean, we've basically gone nowhere all week. We kind of started soggy. We've come back up to where we started, and we're going into this jobs report tomorrow with the markets basically shrugging its shoulders and going, I don't know what in the world's going on. You tell me.
Yeah, it was interesting, right? Like we started the week down, which, you know, it just seemed as though like one of those situations of everybody's back from a holiday, long weekend, sell a few things. And even with that, I think we bounced towards the end of that day. Like I know at one point we were down 100. I think we ended the day down like 40 something and change, which was kind of telltale sign, right? And then yeah, throughout the week, I feel like we've kind of treaded water, but mostly drifting a little bit higher at times. And then today, boy, I didn't have this on the bingo card. I really didn't to end this much higher, but I think it just tells you the market's a little exuberant about the upcoming jobs report. And by exuberant, there's clearly expecting it to be bad. And
you
know what I'm saying? Like it's just clearly that's the situation. It's like, okay, go ahead and show us this bad report so we can go ahead and talk about more of these rate cuts that we got coming down the line. You know what I'm saying?
Yeah. I thought it was really interesting today. So we went all the way sideways into the ISM number this morning. Here it was, the ISM number. It was hot. And you can see how much stocks loved it. But then as soon as that number was out of the way, it was like, okay, let's reposition for NFP because to your point, heaven's willing, it'll be terrible. And then we'll get these rate cuts. And so it's really interesting here because you get this tiny little sliver of evidence that tells you in the price action, this market wants bad news, which is kind of an interesting place for them to be. They want this rate cut so bad, but it's pretty much in the market now. I mean, if you look at Fed funds futures as of today, we got a 97% chance that we're going to get this rate cut. I mean, that's basically a given now, I would think. And looking at the rest of this year, we're discounting 50 basis points. Looking at Fed funds futures here, 53. So small rounding error. But the market and the Fed has been basically in agreement since May. The Fed's been saying 50 basis points since December last year, before the tariffs, before any of this nonsense. And the markets have been on this boat since May. So what are we going to get in this jobs report that's not baked in already in your mind?
Geez, I mean, I think it's hard to say because I think it's expected that it should be a little bit more showing some more softness in the global labor market. I think that's baked in. I think it's hard to say about the unemployment rate. I don't expect it to go up markedly, but I don't know. It's hard to say. That's a good question. I would say. I don't know. Give me some of the inputs. I keep forgetting. I don't know. You guys, you know them better than I do. Unemployment rate, the actual number.
We're going to get the unemployment rate. That's expected to go up to 4.3%.
Which is not market, right? Like, that's not huge.
No.
right?
No, I mean, nominally, right, it'll be the highest in a few years, but that's because it's been ridiculously low relative to history. So if you look at sort of what 4.3 means here, it would be the highest since, let's say, October 2021. But historically, I mean, it's nothing. We historically average something closer to 6 or 7.
Right.
So okay, we're going to go from 4.2 to 4.3. Oh no. Not exactly the scariest thing. The other little bit here that's interesting is going to be average hourly earnings, which is basically a measure of wage
That's what I was trying to think of,
inflation,
yeah.
and that's the kind of thing that's sticky. We're looking for 3.7 versus 3.9 last time. That would give us basically a comeback in sort of the direction of favoring rate cuts. That would be the lowest that we've been since July of last year. So helpful. I mean, when we dipped to 3.6 last year, before we then went up back on average hourly earnings, that's sort of stage setting then for the Fed said, okay, we're ready to cut at the Jackson Hole last year. And then, of course, in September, they went big, 50 basis points up front, another 50 basis points before year end. It seems to get lost in the sauce in this whole conversation that the Fed already cut by a full percentage point last year.
Right.
And so since it takes about, let's say, about 12 to 18 months for a single rate cut to get factored in, we should be starting to feel that easing like right around now. So
I don't know about you, but I don't.
I don't. I feel no easing. So it's an interesting sort of setup. I'm increasingly looking at what's going on beyond this year because it seems like we're pretty well discounted for this year. But we're going to get this summary of economic projections updated from the Fed in 2 weeks. And I think that's really what this jobs report, at least in my mind, in my kind of convoluted macro thinking, I think that's the story. Because for this year, we know what's going on. Next year, there's a big disconnect. Because in June, the markets got the Fed saying, we're only doing one more cut next year because this inflation risk is what we're concerned about, the tariffs, etc. The markets have 80 basis points discounted. So we're 50 basis points apart. That's miles for next year. And if you get a hot NFP number, even a little hot, for how sensitive the markets are to, oh, here comes the rate cuts. If we get a hot number and the Fed comes out in September and goes, or at least the markets then look at the Fed in 2 weeks and go, wait a minute, they're not going to come our way on the outlook for next year, are they? They're not going to adjust the tally. They're going to say, okay, one cut, that's all you get, go home. And we want 80 basis points. That's going to be a lot of disappointment.
A lot of disappointment. And so that's where I was going next with the S&P 500. We basically, for SPX, just the index purposes, at 6,500 today, right?
Yeah.
That expected move was fairly low. It was 43 when Chris and I were on Futures Power Hour today. So what was that, 3 hours ago? And it came into 38.95 at the end of the day for the move for tomorrow.
Yeah.
And so I decided I was just going to go ahead and put a little something on. I did an iron condor, and I got long an iron condor. I did the 65-35, 65-50, so 15 points wide. And the well, I might have messed that up. I just realized that. I did 115, but whatever. I guess that works better, actually. I did more to the downside because that's essentially it. I didn't plan it this way, but this actually makes sense. I did it 15 points wide to the upside, but I did it 25 points wide to the downside. The 64, 65, 64, 40. To your point, if we get a hot number tomorrow, the market is not going to like it at all, and we're definitely going to see downside. And so I just made a beautiful accident, but hey, that works.
I mean, it's an idea that makes sense to me. I mean, I've been doing it with verticals. Basically, once we stalled out up here, saying, you know what, we're stalling. Risk reward would tell you vol is obscenely cheap, so you can buy all kinds of puts for basically no money. So
Yep.
why not just do a put vertical up here? If you're wrong real fast.
Yep.
But if you're right, you got maybe room down into here at first, and then we'll see. So like whatever this fuzz is here, and these bottoms somewhere, let's call it 62.50. If you get a pullback even there, the trade already makes sense on risk reward grounds. And if you're wrong quick, and you didn't pay a whole lot to find out. So, why not?
Yeah, this is definitely some of the cheapest that we've seen puts in a while, skew wise. I mean, the market is literally just continuing to go higher. Even dips are getting bought. We saw what happened on Monday. I mean, it's super cheap to buy them right now, but you just haven't gotten the move as often, right? And even if you did get the move, it's not really, Monday was like kind of interesting because you could kind of tell that the market was going lower. Even when we were down 75, I was like, well, this market definitely wants lower, and it wanted to touch the 50-day, which it got close to. But before it even got there, it bounced. And that was it. That was kind of the end of it. And that's the kind of market we found ourselves in. And I don't know about you, but like in the near term, there really doesn't seem to be much fear about anything. I mean, and I think that's what could change tomorrow. If for some reason we do get a hot report, then the fear turns to, wow, we've been expecting all these potential rate cuts based on a bad job market. I know it's weird, people. I know it's convoluted, but I'm telling you, that's just how things work at times. And that would be the one thing that would probably derail things a bit.
Yeah. I mean, I look at this and I go, okay, this market feels like it's not like it's surviving. It isn't thriving. So this was the Magnificent Six excluding NVIDIA.
Right.
Not exactly great. And they all beat earnings expectations. And by some of them, I mean, obviously, Meta, Jesus, it had a 12% day when it beat, and that was here. And it still couldn't make hay of it. So, okay, we get that sell off. This was the jobs report from that month. Not great. We come back, and if you look at what's happened since then, it's CPI number. Oh, good rate cuts. No follow through. Here's Powell. Oh, good rate cuts. No follow through. Oh, good NVIDIA didn't go completely off the rails. No follow through. So as you look at this, you sort of get the sense that the market is surviving event risk. It isn't finding a way to build a trend. And that feels exhaustion-y, if that's a word that we can coin.
It's just exhaustion with a dash Y on the end, for sure. I mean, do you do dash Y or do you just add the Y? I mean, what's the difference?
I would
just
do dash Y written, but in my heart of hearts, I've just added it.
So the Russell closed at a fresh high for the year today, as did SPX, and we're not happy on the show. So
no, we're not happy
coming on
the show.
That's what I'm coming into.
No, we're not happy on the show. Have you heard me be happy about this stock market on the show in recent, 24 months?
In recent lifetime? No, not in a recent
Somebody's got to do it, Ilya. It might as well be you.
I did buy the April lows, but I didn't stick around. In fairness. So when this craziness went down and we stopped falling right here and we got these long wicks here, it did feel exhaustion like on the other side, and I did buy these lows. It didn't last though.
I mean, I look at this market here. What happened at the end of the day though? Feels like we just squeezed out all the shorts who are getting in line for a bad print tomorrow.
I mean, basically, yeah.
65.12 on the S&P 500. It's not quite a closing high on ESU 5, but the volatility, Jamal, you and I got to speak midday today on Futures Power Hour. Vol came in even more over the rest of the session. IVR in the S&P down from 11.7 to 10.8.
That's exactly what I was just saying before you came on. I was talking about, remember, I'm pretty sure the expected move for SPX tomorrow, pretty sure it was like 43 when we were looking at it, right? When we were on the show. It's 38.90 now. And so, like I was telling Ilya, I decided you had a good idea, I thought, and it worked out even better to wait till the end of the day, and which essentially I did. I actually ended up putting it on as the market closed or right after the close. SPX trades until until 15 minutes after. And so I ended up doing the 65.35, 65.50, 64.65, 64.40 Iron Condor. I told Ilya I actually made a mistake. I didn't realize until after the fact that I did it a little wider on the downside. But you know what? That makes sense. That's exactly what I want.
Yeah.
Because like we said, if this jobs report comes in hot, market's not going to like it at all, and the downside is where it's going to be at. I'm long them, by the way. I'm long them. So the strikes are right.
It kind of feels like it could come in hot. It kind of feels like it could. We've been getting a lot hotter U.S. data over the past 2 weeks. We didn't get an upside estimate on the Atlanta Fed GDP Now forecast today, but it's still miles apart from where market consensus is. We're at 3% for third quarter GDP. Market consensus is somewhere between 0 and 2, in fact, a little bit under 2. And it's not important whether the number is actually going to be 3%. Who knows? What's important is the model has been taking in data and going up. So the tone of the data is positive. And that's really, I think, the crux of it. I think if the market wants validation of rate cuts beyond this year, I think as we were just talking, Jamal, I think the market is done speculating on this year. I think it's pretty set now. It's next year. And if they get a sense that the Fed is not going to come their dovish way next year, I don't think they're going to like it.
I guess the question is, how do we trade around tomorrow then? Jamal, I think what held earlier today still holds now. Kicking around that whole, where's the expected move for tomorrow? Now it's only 36 points through the end of the day. And it's a non-farm payrolls report ahead of a Fed meeting. Ilya, that seems lightly priced. Instead of expecting this to be an inside day where you do something like a short iron condor, reverse iron fly, buying the at the money call and put, selling the wings out at the 1 standard deviation move for the rest of the session. It seems like it's a better risk to reward, just given the context of everything that's going on right now. Like, regardless of what the print is, the market's going to move.
Yeah.
That it's going to move away from where we currently are. It's not going to be pinned.
Right.
So we should be trading along those lines right now, expecting us to move away from 65.10. Whether or not that's up to 65.65 or down to 64.65, what have you, that's another story. But maybe Jamal and I were having trouble reconciling this earlier. Why would traders be looking at tomorrow's non-farm payrolls report and not putting it on the same pedestal as Fed Chair Powell's speech last week? Is it because you think this year doesn't matter anymore for the cuts? We're fully priced for what's going to happen. We're on a preset course. Next year's the only game, as you just mentioned.
I think so, and I think it's why we didn't get follow through on the CPI number. It's why we didn't get follow through on Powell. They were both good for 24 hours, and that's it. The market didn't have repricing to do. They just got pieces of data that basically said the thing you already know, here's some validation. Let's take a little bit of uncertainty off the table. Okay, now let's take a little bit more uncertainty off the table. And obviously, the market doesn't like uncertainty. So when you take a little bit of it off the table, the market goes, "Hey, all right, this wasn't as bad as it could have been," right? Because anytime you go into event risk, there's the slight off chance that you're totally wrong and the number comes out bonkers. We saw that with the NFP report last month, where the market got something way different than they expected and went, whoa, okay, hold on a minute. And there was a sell-off. And it didn't last because what the markets want is rate cuts. So a bad number isn't something that does lasting damage. But it was a shocker, especially the revisions. And so the market got a little weak-kneed as it was digesting it. But you get a piece of news that validates what you already thought was going to happen, but there's just a little bit of uncertainty that goes away just because you're on the other side of the event risk, and now nothing bad is going to happen. Now you can wrap yourself in your security blanket and go, okay, just wait until the next one. And that's exactly what happens. CPI, jump, standstill. Powell, jump, standstill. Because they already know. They've known since May.
We've known since May, but it's also the environment we're in right now. I mean, the seasonals in August weren't fantastic. If you traded along the lines of them like I did, you got smacked around. And here, if you did so at the start of September, you did pretty well. And then ever since the first hour of trading on Tuesday, it's been basically a straight line up. Volume's
and now
low.
We're basically unched for the week.
Oh yeah, we're a little bit more than that in the S&P, but I guess what I'm getting at here is that there's clearly positive technical drift again, slope of the 1 month, the 50-day, the 5-day, 1 week. They're all positive and they're all higher, faster pace of acceleration than they were yesterday. Volume's low. We barely crossed 1 million contracts traded, Jamal. We were at what, 700,000 when you and I were on a few hours back, and now it's only 1.1 million. So low volume, low volatility. Low volume, low volatility, positive technical drift. Jamal, I mean, I guess what I'm getting at here is this is the kind of setup that we've seen so many times over the past few years where you just got to be long the market and not think.
Yeah, and I truly mean this. Like when I ask you guys, like, well, what's really the wall of worry right now? How many times when we're trading a market day in and day out, and you can name off 3 things, not that could potentially happen, that are currently affecting the market, right? Like there's usually some geopolitical thing in oil going on. There's something, else. I mean, of who knows, whatever it may be. But there's usually like 3 to 5 things, depending on how bad the market currently is. I challenge you to name 3 things right now that are actually currently affecting this market. I think you can only really name 2. It's really rate cuts and it's tariffs. I mean, those are kind of tied together in some way, shape, or form, right? It's almost like it's one. There's just not any geopolitical thing right now that's affecting oil, and the market is really worried about. There's not, a current like war that is fresh, that is new, that the market is fearful of. I mean, this is currently the market that we're lying in, and honestly, I mean that we're lying in right now. And honestly, I think it's I think you either are long, right? Or you're just going to sit out for the time being until things do get, you feel like there's going to be a pullback coming at some point in time, which, I mean, I can understand, honestly, both right now, to be totally honest.
Just quickly here, Broadcom, its earnings are out, reported third quarter earnings that beat expectations and provides good guidance, but not much of a change here in the share prices after hours. EPS, $1.69 versus $1.65 expected. Revs were at 15.96 billion versus 15.83 billion. They're also guiding for 17.4 billion of revenue in the fourth quarter, higher than the 17.02 billion anticipated. That means this is revenue in the third quarter is up 22% on an annual basis. Not too bad. Share prices obviously have doubled in the past year. So we'll see how we say pin.
Expect a huge move, honestly, after the NVIDIA. I kind of expected this to do what it's doing now. Now, I don't know if they've had the call yet. That might be different, might change things, but it seems like this is par for the course.
Yeah.
I mean, this is very good news to Ilya's credit, right? We're not thriving, we're surviving. I can imagine an earnings report like this. Headline on CNBC right now, as I just scrolled over it. Broadcom reports 63% jump in AI revenue as results beat estimates.
Give me this report last quarter. We probably have the markets uncorking champagne.
Yeah.
Well, listen, there's still time, Ilya. New Year's isn't until December 31st.
I don't know. See,
plenty of time for champagne this year.
I mean, a year ago, if we saw that headline, stock would be up 20%.
Yeah. Yeah.
Well, maybe we got the news early today, right? Because you see how the NASDAQ's performed here over the course of the session. It was a relentless march higher into the close. And here after hours, we're holding on to the gains post Broadcom. So maybe we just, you know how these things are. It's material, non-public information. So naturally people are trading on it.
Put a cursor on the ISM release today, because I think we got a little bit of a squiggle here telling us what the market thinks of hot economic data, and then we promptly went on to go, okay, but NFP tomorrow is going to give us our rate cut, la-di-da. But you saw what the markets thought when the data came in hot. They didn't like it. It didn't last, but you got a sense of what the knee jerk is. And obviously, ISM is not the kind of impactful number that NFP is. If NFP is hot, it's going to look different, especially on a Friday with no meaningful earnings to look ahead to. And a Fed blackout next week. They're not going to say a peep next week because we're already setting up for the rate decision on the 17th.
Yeah, the Fed doesn't. Well, do we care about anyone other than Powell?
No.
John Williams, the head of the New York Fed
we
today.
also care about Lisa Cook, but less what she says and more
and who's staying in her house,
what she borrowed, and for what house.
Yeah, that's a good point. I mean, next Thursday we're going to have inflation data coming in hot on September 11th, so watch out for that. Plus the ECB rate decision. But yeah, it's during a Fed's communication blackout window. So we turn then to. I guess is the Wall Street Journal still our best bet to get insight into the Fed, like Nick Timmeros?
That's what I watch.
Lululemon had earnings too. I kind of forgot about it. I mean, I want to forget about it. I had some calendar calls in there. It's not a huge position, but I was trying to play contrarian on this one, and I just got to say now this stock is probably done, man. I mean, I don't see how it's not. I don't know exactly what they said. I assume something related to clothing and tariffs, but I thought a long time ago their stuff was overpriced, and clearly now the rest of the market does too.
What did Lululemon do today? Lululemon, their shares are down about, what, 13% here?
Yeah, it was up on the day.
They were up over nearly 4% today, but they're down about 13% here after hours. They assume a $240 million hit on tariffs related to their directly for their margins. They say that includes mitigation efforts, pricing actions, and the removal of the de minimis exemption, the company said.
Yeah, that's not good news. If you're shipping little pieces of clothing that could slide in under that, you don't like that.
No, Lululemon does not like that, and neither do investors who are trading the share prices down. You don't see a collapse in volatility here, by the way, after hours, so that's sticking around.
All those drop shippers that tell you to buy their small niche boutique stuff on Instagram, and they go, you know what? Forget Lululemon. These sweatpants are the sweatpants, or these yoga pants are the yoga pants, whatever it is. Those are tiny little baby businesses all around the U.S. The de minimis exemption is their lifeblood. Those businesses don't get it anymore. And they don't have Lululemon's money.
No, they don't. I trust that Lululemon, like so many of these other companies that have had to take tariff charges, right? Like
you saw it in the PPI number.
We know that it's not the foreign. If the foreign countries were paying the tariffs, why would Lululemon have to take a tariff charge? Just let that simmer for the folks that tariffs are not paid by American consumers and businesses.
Right.
Chew on it, think on it. Light bulb should be going off by now.
Judge Dredd obviously goes to the foreign countries and collects the money, because how else would we get other countries on their jurisdiction to pay us? We must be going over there with Paulie Walnuts, rest in peace.
But Jamal, like one thing that I noticed this week, and I'm very cynical here. Trump tweeted out that they've brought in $8 trillion between tariff revenue and investments to the United States as a result of Trump's trade plans. Now, obviously, $8 trillion is more than the entirety of all of our trade. So that doesn't seem feasible. But the market is not reacting to headlines like that anymore. And I keep saying to Ilya, it feels like we have this innocent until proven guilty thing going on. Like a boy who cried wolf almost. The wolf is out there making a lot of noise, but he hasn't blown down the house yet. So until he actually does, you got to ignore it. I know that's a sign of complacency, but isn't that the mindset that's succeeded here since Liberation Day?
I mean, essentially it has. And, I don't know the plan of the administration overall, but you can just look at the facts for the most part. The dollar has fallen overall, right? There's all this impetus to try to get a lot of these companies, Apple and all these other, people who do a lot of business overseas to try to come to America, which seems like an insurmountable feat to get production and all those type of things to happen. Which is one of the reasons why you see a lot of them going to the White House and having a lot of discussions. I don't know how it ends up playing out.
Discussions.
Yeah, discussions, right? Just one way to call it. There's a lot of other ways to call it.
Shakedown would be another. But
But I do wonder, man, at what point it does become enough for the dollar, or at some point, like politics to the side. If there was a real way to actually get all of this investment into the United States, at some point or another, it would turn around the dollar. I mean, at some point or another, right? And so I don't know if that's the desire, that's the want, but I do know, like, the way that we're going right now, it eventually does have, there's a reason why there's so many people short the dollar, and it does have a serious effect on your own currency when you're doing all the things that you're doing overall. So, of course, we know there's been there's been a lot of pushing on Powell and leaning on Powell, I should say, to lower rates. I don't know if there's an inflection point where tariffs and low rates work. I honestly, I know theoretically what happens, but I don't know if there's a way. There's a lot of things that I thought theoretically would happen over time, and especially in these last few years where rates changed, that didn't exactly happen. So I don't know if there's a world where lower rates and these tariffs work, and eventually it leads to a dollar rising again because everybody's investing in America. I don't know, man. I really do wonder. And some part of me thinks that me wanting to get long the dollar is like, maybe that whole thing ends up working. I don't even know.
I'm on the dollar, and it's not because I think the thing is going to work. It's because I think the Fed is going to disappoint these dovish expectations. I also think that the dollar, being a kind of risk-off cash of choice, is going to reclaim that mantle. I think obviously there was a pretty big scare around Liberation Day where it looked like the U.S. was against all advice going to cut off its nose to spite its face. But then when the markets, in the president's parlance, got yippy and we sold stocks, bonds, and the dollar all at the same time, it seemed like market discipline worked. We got a 90-day pause. We got some backing up off the worst of the foam board tariff rates, and things kind of settled. The dollar hasn't fallen since July. It's been bottoming for a couple of months now, and that's with all the Fed speculation, with all the hope on these rate cuts. That tells me it might be done. I thought it was really funny that people thought going into the tariffs that the tariffs would be dollar positive for some strange reason. Right. But then, obviously, in the first 6 months of the year, everybody got religion and understood. If you reduce global trade and the currency of commerce is the dollar, less trade means less need of dollars to finance it. So less demand for dollars. I mean, that seems pretty straightforward. So I was short the dollar all through the first 6 months of the year. In fact, it paid for my sins in the equity market. But I'm long now. I think it's done.
So the rationale with how tariffs can be supported for the dollar is twofold. The way that Trump did it is so disruptive that it wouldn't follow this path. But if you were to make a marginal adjustment to tariff rates, in theory, there's fewer American dollars going abroad to buy foreign goods, and therefore we need to convert fewer dollars into foreign currencies.
If that works.
But at this point in time, as Federal Reserve data shows, so that's like the macro theory, the actuality is that 95% of our imports are already billed in USD. So that doesn't necessarily matter.
Because it's
what you're really looking forward to
is the global currency of commerce.
What you're really looking to is that if tariff rates bump up inflation at the margin, then incrementally you'll have to have higher structural interest rates moving forward to counteract that inflation. And therefore, whatever commerce is lost or demand for the dollar is lost from abroad for recycling, money into our instruments, it's picked back up. It's made up on the other end because we have a better interest rate differential. But we didn't get that benefit this time. Our interest rates went up, and people treated.
To your point,
we might, but the initial reaction was interest rates go up, sovereign credit risk.
Yes.
Right. The U.S. removing itself from the system.
Yep.
Not like, okay, and where we are today.
First recession risk, because the business and consumer confidence surveys turn in February, and everybody goes, these tariffs are awful, they're going to cause a recession. So stocks fall, the Fed outlook gets a lot more dovish, dollar gets absolutely shellacked. Then you get off, to your point, the sort of extreme version of that, the sovereign risk episode. Stocks rebound. The outlook for the Fed never really recovers. It just shifts from rate cuts being mainly centered on this year to rate cuts being centered on next year. And so
Jamal's question earlier today was if the dollar is still bottoming, because he mentioned, we skated through this on Futures Power Hour, and we both said that we would talk about it here with you today.
Yeah.
Where's the best place to express dollar strength right now? Because I'm looking across the board and I see these little inklings, like on a day when yields are lower and gold and silver are getting slammed, the yen and the Swiss franc are getting hurt in a material fashion.
Yeah.
Right. And that's not something that we typically see a lot. It's almost like there's a buy America kind of thing going on. Higher dollar, higher bonds, higher stocks, lower gold prices. And that's ahead of non-farm payrolls tomorrow.
Yeah.
So kind of square the circle with me. What do we get out of non-farm payrolls tomorrow? What do we need to see from non-farm payrolls tomorrow to keep this dollar rally going? And then after you answer that, Jamal, I want to know what you're trading to exercise that point of view Ilya's outlined.
I think for me, what you have to see is a hot number. And I don't think the hot number is going to change anything about what the Fed's going to do in September. But I think
define hot, because the expectation is 75K.
So the expectation is 75. Let's say we get a triple digit number. I think that would be hot enough. Let's say we get an unemployment rate, because the payrolls number is always a little bit squirrely. The unemployment rate has been the more kind of consistent, not subject to a gazillion revisions, more solid number, and it comes from a different survey. If you want to get nerdy on how the NFP numbers are done, there's surveys, and there's two of them. There's the household survey, there's the establishment survey, and different pieces of the report come from different surveys. The unemployment rate is a steady number. It doesn't get revised a gazillion times. It's not volatile. We're expecting to go up to 4.3. Let's say we don't, and we get 4.2 or even 4.1, and we get a triple digit NFP number without awful revisions. Let's say we get 75, but the revisions are positive, and some of the crazy downstream revisions that we got last time get washed away on second thought. Anything that tells the markets the Fed is not going to go their way in the summary of economic projections in what now, a week and a half, 2 weeks, anything that tells them markets are at 80, Fed is at a 25 basis point cut, and the Fed isn't going to adjust it. The Fed isn't going to even go to 50. Anything like that, and I think stocks don't like it. The dollar rallies. I think the yen is one way to do it, but I think the euro actually is the most attractive because it's got the cleanest top, it would seem. The pound is an interesting one, but for me, the euro is sitting right on range support. It's not rocket science to see where the break is there. I think another one that's been really kind of congested and consolidating is the Aussie. And if you got a risk-off thing, the Aussie would be probably the hardest hit. It's really struggled to go anywhere since peaking out.
Since May.
I mean, it cannot figure a way higher. And if it's risk on, you wonder why, because this is basically the currency market's version of a risk on asset. So if you're going to get some pain, This is another one where it's pretty straightforward. You know where support is. You can see the risk reward. If you're wrong fast, and you get out. I'm not even doing this through options. I'm using micro futures and I'm outright short. M6A, M6E, M6B, MCD, which is the Canadian dollar. On the spot side, I'm long dollar Swiss. I'm long dollar yen. My boat's full.
So Jamal, if we're thinking about still playing dollar strength here and it's weathering the storm, yields going down, Fed rate cut odds going up, it's just been too crowded of a trade for so many people. Where are we playing this view? How are you handling this?
Well, I can just tell you partly from what things that I have on already. So I mentioned the SPX, the Iron Condor. I mean, it's basically a broken wing Iron Condor at this point, kind of. And that would work for tomorrow. If that happens tomorrow, that would work for tomorrow. I think we're going to get a move that goes below my short strike is 64.40. I think we get a move below that. We're easily down 60 to 70 handles from here. I am to Illy's point. I am long the dollar via that euro trade. I am long a put spread in there, and this is part of the reason why. Besides the SPX trade, I felt like I kind of had to do it because of different long deltas things that I have on. But this is part of the reason why any big macro trade that I have is more than further out than October. Because, this talks about silver, I'm talking about gold, I'm talking about the dollar. Because it's really kind of, things aren't exactly fully making sense right now in some way, shape, or form, right? And so because of that, I think you just need a little duration on some of these things, particularly when you're talking about the dollar. You know what I mean? So that's why I have a lot of those out there. But I got the put spread in the dollar and the euro, excuse me. I got the only near-term real macro trade, if you will, I have is that SPX Iron, the SPX Iron Condor. And, I have... like I said, the other thing that's going to happen is gold and silver would probably get whacked tomorrow, which would suck, but I think it'd still possibly be in play. It just depends on how bad this situation is. I think the biggest thing that they're holding on to, obviously, is rate cuts at some point. So obviously that's going to dampen that some, but will it kill it all the way? I don't know. It would be interesting to see if this 90% expected rate cut drops below 50%. I mean, that would be something else. That would be pretty wild with, less than 10 days to go for this meeting. So it's the euro. If I do decide to do another, way to get long the dollar, it's probably yen at some point. I mean, I don't know if I'm going to do it right off. But I'd rather express those opinions in that way. I know a lot of people. We often talk about UUP on this network. I don't really like that as a product, honestly. I think it doesn't move the same way, and it's not the same exposure, right? It's just not the same as dealing with one of these currencies. One of the things I wanted to ask you guys, and I know we mostly use probably micro futures, but I was just looking through, and I noticed this today on the show, and that's why I teased the idea of talking about the dollar, Chris, at the end of the show on the Futures Power Hour today. But looking at these futures, it's interesting to me that when you look at margin on all of them, right, Aussie, whether you buy or sell, it's the same. The only one that's different is the euro. It is way more expensive to get short the euro than any other of these currencies. I wonder why that is.
Theories,
I don't recall the CME changing margins.
Well, just look at the buying power for getting long and look at the buying power for getting shorted.
Yeah, the euro is expensive relative to the others.
But I mean, just saying within the euro, it's not even the like for yen, it's expensive, but it's equivalent whether you want to buy or sell. For the euro, it's like twice the amount of margin to sell versus buy, more than twice actually. I just find that interesting. A lot of times, when you talk about changing margin requirements, we know it's because it's an interesting trade, to be honest with you, right? When gold was really going, they raised their margin requirements. We know how that goes. It's just kind of fascinating to me that it's higher margin.
Yeah, the margin's like 23% bigger for going short than going long right now, just outright futures. I mean, is that an artifact? I actually didn't see this earlier today when there was more liquidity. Is that an artifact of where we are during the day, or is that something you've noticed recently?
I just noticed it today, and I'm just curious if it's one of those situations where there's just that many more people that are shorted. I don't know.
I haven't noticed that the margin is different in either direction, but I've definitely noticed that the euro is more expensive. I think that's probably a function of volume. It's sort of generally relative to other currencies, but the difference in buying or selling, that's interesting. I haven't noticed that until you've just mentioned it. I wonder.
It's an incredibly crowded trade still. Like the Z score for the
Yeah,
euro, looking at
I'm gonna
positioning in the
check here.
futures market for speculators, is still north of
Yeah.
1.2. So 1.2 standard deviations above its 20-year average. I mean, like, look, Jamal, I think this is worth bringing up for this crowd here too. Thinking about always going back to what's the trade. One reason why the dollar may have a little bit of a better time ahead of it is because of what's been happening in gold and silver.
Mm-hmm.
You and I highlighted earlier today periods when gold or silver had exceeded certain percentage thresholds above its 1 month moving average. Just a trade getting too long in the tooth. Some of these other episodes when silver has been 5% above its 1 month, when you've seen that same type of price action in gold, right? Just getting stretched. Where have we seen this recently? Well, we had it flash yesterday on September 3rd. Prior to that, you have to go back to June 9th, okay, for silver. This is gold up here, but again, thinking about both charts, behaving similarly. What happens after June 9th here? Gold is just moving sideways. It's not rallying. We have to go back to February 4th, which in early February, you get your rally in gold and silver, and then it basically does nothing for the rest of the month. Before that, October 22nd, 2024, I think silver emphasizes this a little bit better, but you have one of these dates right here, right? So silver does nothing for the rest of the month. October 22nd is this date. What's the point of me bringing this up? When gold and silver get into this realm, 5-7% above their 1 month moving average, they tend to be at a place of resistance. They've gone too far too fast. It's time to slow down and catch a breather. And so if these guys are going to catch a breather right now, then it would stand to reason that even in the face of those lower yields that we saw play out today, the dollar is probably well positioned. And then we think about all the themes that have worked with us over the past several months, especially since April 2nd. The buy America, sell America is the one that sticks out most because you have that alignment today. The gold down, the bond yields down, dollar up, and stocks up. So I would just wonder for tomorrow, if we get a Goldilocks print, it's 65K, 75K, 85K. It's weak enough to justify rate cuts, but not weak enough to make people think we're sliding into imminent recession. That's exactly where the stock market's going to want it. You're not going to get more cuts priced into the curve, Ilya, so the dollar could have a chance to rebound. Plus, if we get one more cut priced in for this year anyway, I mean, how far away are we from it? 60%. So it'd be a little bit more dollar weakness, and then, so like the bottoming process could continue. We don't need to price in a full cut. We have to add half of one back in, basically. I'm leaning long bonds. I'm leaning long stocks. I'm long the dollar tomorrow. I'm still long silver. So I'm ready to go. I mean,
I was just thinking about that. Okay. This is the one thing I do want to know. Tomorrow, you just said long. Because I'm long the same of them. Like I'm long stocks. I'm long bond. I'm not long bonds right now, but I'm long stocks. But let's just say long stocks, long bonds, long gold. Let's just put gold and silver in the same, and long dollar. Which two disappoint tomorrow? Stocks, gold, dollar, bonds. Which two disappoint?
Gold is going to disappoint me tomorrow. I'm long gold, I'm long bonds, I'm long dollars, I'm short stocks. I think gold is going to make me suffer tomorrow.
For my sake, I hope stocks also disappoint Ilya. Because that's been the
story. That's been the story since the beginning of the year. Thank God for cheap vol and verticals.
Jamal, you're not here with us that often. You have the final word as we close out this week. Overtime's going to be back next Monday. Dylan will be back with us. What say you for this trading week as we make our way through the first week of spooky September?
It was a really good week, and I'm not going to lie. I'm worried that it might turn, and I'm worried that stocks fail. I'm worried that gold fails, and I'm worried that bonds fail. And that's going to set up the rest of the month being really, really wacky.
Eagles Cowboys are playing tonight. As a New Yorker, I'm rooting for a meteor to hit the stadium. And with that, overtime is out of time. We'll be back on Monday, same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Jamal Chandler in Chicago, I've been Chris Vecchio in New York. Good luck trading. Brief break. Tasty at Night coming at you. Ilya Spivak with Macro Money up next.
See you there, everybody.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Frequent trips to Vegas, or there was a year I did a couple of them.
What's the most financially irresponsible thing you've ever done in your life? Doesn't necessarily have to be trading specific.
Financially irresponsible, that's a big question. Like people would say like going to college these days, I don't know. Renting, I like renting. I like the flexibility. I don't know. Maybe renting, I guess, by the book is financially irresponsible. Actually, you know what my biggest purchase right when I started my job was $4,000 on a PC setup, which was not a good idea at my salary point.
I mean, anytime you take a trip to Vegas, it's pretty financially irresponsible. I would say that frequent trips to Vegas, or there was a year I did a couple of them, which was pretty irresponsible.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
So I've been trading for about 5 years, maybe 8 to 5 years, and I got in the options world because I wasn't making enough with just holding long equity. You know, there's not a lot of strategy. It's just sort of like buy it and then pray it goes up. I found Tasty Live from my friend, and I started looking at the YouTube videos. My favorite part about it was just that there was math, there was probability, it was something you could consistently rely on. Once someone gets the right information, which they provide on Tasty Live, they can really change their financial situation for the better. Consistently, not, oh, I bought a stock and it went way up one time, but how can you do it consistently over and over? And with Tasty Live, I was able to do that.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities, and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you would like the chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Well, the markets are finding a little bit of solace here as we head into the end of the week, a little bit more chipper from Wall Street at this point. But will we get some validation? That's the question we're asking ourselves here on Macro Money. I'm Elias Pivak, head of Global Macro here at Tasty Live, and we are within striking distance of what is perhaps the biggest piece of event risk for the week, and certainly the one that we care most about as macro type folks on this show. And of course, we're talking about U.S. jobs data. And what we're going to do here is we'll take a look at what all of this might mean. We'll take a look at what happened in the markets going into this situation and see if we can't break down what this is going to mean, and more than anything, ask ourselves, what is the reaction function in the markets here? What is it that this data is going to do that's going to make the markets happy? And what is it that that this data might do that is going to give investors something of a pause, some indigestion? What could they look at that would be a disappointment? And see if we can't figure out which way this thing is likely to lean. So first, let's just consider how the markets did today. It was a nice day for Wall Street. S&P 500 up almost 0.9%. NASDAQ managing to round out the full number, up 1.01% there. Yields down across the board, so markets seemingly setting up for this jobs report tomorrow. 10-year down, 2-year down. Crude oil still marching to the beat of its own drum, doing not much of anything. Gold pulling back a little bit. It was a much bigger loss, but if anything, this really gives us the sense for what was going on here today, because gold really didn't have a very good reason to be going down on a day, or at least it would seem it wouldn't have a very good reason on a day when bond yields were off 1.4% on the 10-year and off nearly 0.9% at the front end. So gold more so looks like it is in some kind of a consolidation situation ahead of what is, of course, critical event risk, rather than anything that seems to say, oh, we're going to end up with some kind of an outcome on this jobs data that is going to be untoward. Instead, it seems more like we're looking at gold that's been surging up a storm here, hitting fresh record highs and doing it in explosive fashion over recent days. As we get into this event risk, the market just wanted to get a little bit of that speculative froth off the table. At one point today, to sort of give it a sense, gold was down 1.42%. And it finishes the day, obviously, with a much more modest loss. So it seems like we're looking at a situation that's more corrective than it is direction flavored. Bitcoin down 1.9%, dollar a little bit stronger, up 0.1% against the euro, up almost 0.4% against the yen. So kind of a hodgepodge, not really a strong directional lead here. But as ever, if we look at the way the markets have performed week to date, we see that Bitcoin's recovered a little bit, up 1.75% after last week's brutal, nearly 7% sell-off. So on the whole, Bitcoin obviously meaningfully lower than it was a week and a half, 2 weeks ago, but it managed a little bit of a baby recovery. The dollar continues to strengthen. Last week, the strength was modest. Now it seems to be picking up, especially against the yen. The surge in gold, of course, continues. It surged last week. It's continuing to do so this week. Basically a wash for crude oil. Last week up a little bit, this week down a little bit. It's still oscillating in that familiar range. Rates are the big story this week, where things are heading meaningfully lower there. And of course, last week, more of that. So that's a trend that continues. And stock markets had a bit of a soggy showing last week, and at least so far, it looks like we're getting a little bit of a recovery, but of course, we're still in these familiar ranges on the major indexes. We haven't really gone very far at all since almost a month ago. And so it's an interesting sort of setup as we go into this event risk. Before we get there, though, a little bit of a note about what happened here overnight and into this news that we just got today in the U.S. session. Of course, the number we were watching closely was this service sector ISM number. And yesterday on the show, we talked about how the tea leaves suggested we'd get an upside surprise, and we got that. 52 versus 51 expected, a meaningful pickup in U.S. service sector activity growth, meaningfully more positive than the markets had on their bingo card. And if we look at the internals here, we can see this is not dissimilar from what we had on the manufacturing numbers, that part of the survey, which we'll take a look at in just a second, earlier in the week. So overall, for the service sector at 52, we're looking at the fastest service sector growth since February. So this is a meaningful recovery here. Never mind that it's better than expected. It's fairly chipper even in absolute terms. We see that we get a little bit of a dip in prices, although inflation is still very elevated in the service sector. On the employment side of things, we're still contracting. So this is, of course, in the logic of PMIs, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And here you can see we get this new orders number coming up from basically standstill to strong orders growth. This might line up with evidence that wholesalers are starting to pass on inflation costs to consumers, and margins are expanding back out again. Employment still in contraction territory, but at least it didn't get worse. So the pace of employment contracting did not accelerate, as it were. We likewise had a situation on the manufacturing side earlier in the week where the price decline has been a little bit more consistent. And of course, here the tariffs are much more front and center because this has to do with goods. Services are mostly serviced domestically. And here you get a very clear view where the price component is coming in, and so new orders are up, though employment, again, still in contraction mode, but at least it seems to have stopped falling. The final revisions of S&P Global's version of the PMI data, not really meaningfully different from initial estimates, a little bit softer on the composite and the service sector numbers. But again, even looking at this, the mix is a little bit different. The survey construction is a little bit different from the ISM, as is the timing of the surveying. But you do get the sense here that the U.S. economy seems to be on a path toward reaccelerating over recent months, and it's not quite so dramatic in ISM, but you are starting to turn. And of course, the service sector is the biggest one of the bunch. It's close to 70% of the overall economy, and more than that of overall employment, closer to 80%. And so there does seem to be this sense that the U.S. economy is starting to find some more momentum. And it is with that we go to this U.S. jobs report that, of course, is going to be the biggest piece of data for the week. And perhaps the most interesting bit here seems to be that we're looking at a situation sort of fundamentally where the markets want bad news. Now, they don't want catastrophic news, but what they don't want is anything that upends rate cut expectations. And we saw it with the ISM today. It wasn't lasting. The markets clearly didn't want to have any kind of directional conviction as the NFP number gets closer. But if we take a look at what the markets did today, when that ISM number came out, and it came out hotter than expected, we promptly fell across the major indexes. And we managed to hold the downside for maybe about 15, 30 minutes. But it was a significant sell-off. It took us down to the lows of the session before we rebounded. In fact, if we were to take a look here at what could have been, perhaps, were we not looking at the NFP report that's immediately in front of us, we might have been looking at a meaningful decline. The overall size of the swing from where the data printed and into the daily lows was not the worst, but not nothing. We declined close to 0.2% just in about 20 minutes time. And it was from there that things started to really ratchet up in an almost straight line, to give you the sense that the markets just wanted to get on the other side of event risk and get ready for what this is going to be. The expectation is 75,000 jobs added. The unemployment rate going up to 4.3. Nominally, that's the highest since October 2021 or so, but obviously, historically, the unemployment rate has been much, much higher, and the historical average is meaningfully higher. It's closer to 6 or 7. So 4.3 isn't high, but it's high relatively speaking. And you can see here the trend has been for a cautious increase for a while now. The trend in job creation has been for a cautious decrease in the magnitude of gains for some time now. The 75K number would be a slight improvement over 73K in the prior month. And the logic here seems to be, well, the markets want anything that doesn't upend rate cut expectations. So what would need to happen here? Now, the lead-in, we got a bunch of jobs data today to give us a sense. The lead-in is a little bit soggy. The 4-week average for jobless claims we can see has been climbing. In fact, we're now sort of into June levels here, give or take. We got the ADP employment report. That's a private sector payrolls estimate. It doesn't line up very cleanly with NFP, so don't take this as gospel by any means. But the expectation was for 65K, and what we got was 54. So not the upside surprise one might have been looking for here. We're one to look for that. And the weakest number that we've seen since May, that's here. But nevertheless, the trend for U.S. economic data, and we said this ahead of ISM yesterday, it's been increasingly rosy. So this is the Citigroup Economic Surprise Index, and we can see here the zero line is where you separate upside surprises versus downside surprises. Under zero, you're surprising on the downside relative to forecasts. On the upside, you're surprising higher. And of course, this is sort of whatever the expectations are for any given piece of data. If it surprises higher, the index goes up. If it surprises down, the index goes down. And it's scaled by the more market moving things. So when the move is big, the index moves more. And it gives you a sense for where outcomes are relative to economists' forecasts. And we can see really since July, we've seen data that's been tending to outperform relative to forecasts. And especially over the past 2.5 weeks or so, the data has really pounded upward. And at this point, we're at some of the highest levels that we've seen since back here. This is sort of the second half of last year. And so the tendency isn't so much for data that's good. That's not what this is saying. It's for data that's better than it expected. And of course, ISM was a case in point today. Moreover, the Atlanta Fed's GDP Now model, never mind what it actually says for third quarter GDP, it'll be a while yet for that number to look like anything that approximates real results. There's a ton more data that's going to go into it. This is not a forecast, it's a nowcast. So it's constantly taking in new data, and the model is adjusted sometimes on consecutive days. The important thing is here's the model, and whatever data it is taking in has been increasingly positive in recent weeks. Not surprisingly, going back to about the same point here as what we see here. So this and this is telling us U.S. economic data is getting rosier. Now, what might this mean? Well, ISM today, again, is a case in point. It doesn't mean much, probably, for near-term policy expectations. The markets get only more convinced today that we're going to get a rate cut in September. 97.4% chance that that cut is coming. But the bigger deal seems to be the disconnect thereafter. So once again, if we take a look at where the markets are versus where the Fed is, we can see the markets have been basically anchored around 50 basis points in cuts since around May. There's been a little bit of a wiggle on the downside, a little bit of a wiggle on the upside, but nevertheless, this is it. We've been basically pinned here. And that lines up with the Fed's own forecasting. This is the latest summary of economic projections, and we can see the Fed's been saying 50 basis points. They said it in December of last year. They said it again in March. We can see that here. They said it again in June. The current median for the Fed funds rate is 4.4. Down to 3.9 is 50 basis points in cuts. So the markets and the Fed, they're aligned. There's not a whole lot of speculative juice here. The markets know what's coming. The Fed's only got 3 meetings left for the year. They're almost out of calendar. There's only but so many ways you can slice and dice 50 basis points over 3 meetings when you already know that one of them is coming in September. So either we get another cut in October or we get another cut in December. It doesn't much matter. The larger issue here is that for next year, there is a vast disparity. The markets are at 3 rate cuts, 76 basis points with 75 in and 1 basis point of rounding error or something of the sort. But we can clearly see here, 3 cuts are fully discounted. Look at the Fed's calculus, and we go from 3.9 to 3.6 That's a one cut forecast. So there's clearly a big difference here. The Fed thinks they are not going to be able to do nearly the stimulus that the market thinks that they are going to be able to do. And so this is where an upside surprise on the NFP number would be most unwelcome. Because if we then take a look at what would happen, I mean, chances are we're so baked in for this month's outcome that we're probably not going to get very far. Let's say you dilute the probability from 97 to 90. Let's say you dilute it from 97 to 87, even lower. It would be some kind of a minor catastrophe if you had to dilute the probability of the September move somewhere back below the 50 mark. So we're going to get this cut. And chances are we're also going to get the 50 basis points that the Fed's been talking about. The markets are there. The Fed is there. It's probably a done deal. The larger issue is this disparity and what the Fed says in the summary of economic projections. Now, does this disparity matter? Well, it would seem to. Here is the S&P 500 against that rate cuts outlook, and we can see how this has developed. Here's the beginning of the year. This is mid-February, where the markets initially start to worry about the tariffs because business and consumer confidence surveys tell us that nobody likes these tariffs and they're all expecting it to be a growth risk. So expectations get more dovish. Stocks fall. Obviously, the crescendo there is Liberation Day in early April. Then we get a little bit of fuzz while the White House walks back the worst of their assaults on the market's kind of infrastructure. For a while there, it looked like the administration was going to, despite the tremendous benefit that the U.S. reaps from a dollar-based and a U.S. Treasury-based financial order, that they're going to upend those norms. And despite all logic, cut off their nose to spite their face. But that isn't ultimately what happens. The administration actually shows that they are responsive to market discipline, that when the markets get, as the president said, yippee, they back away. And so we very quickly get a 90-day pause on tariffs, and the markets go, oh, okay, this is not what we thought. This is not a reason to get hysterical. This is not the end of the U.S.-based global financial system. And so stocks obviously recover. We come off the lows a little bit relative to policy expectations, but notice what happens here. This is May. This is where the markets anchor around this 50 basis points that the Fed already told them is coming. Then the outlook starts growing increasingly dovish again, and we're almost back at these lows. And so once you kind of recover back to within earshot of the starting line on this sell-off, the dynamic changes and stocks start powering higher as the outlook for easing for next year grows. And so it's very easy to conclude here that much of this vigor is rate cut speculation. Interestingly enough, when you look at the way the dollar has behaved, it sells off with gusto when this is starting to adjust down. It never really rallies like stocks do on sentiment grounds. But even as we get more and more dovish on the outlook, as of the beginning of July, it stops falling and has been attempting to carve out some sort of a bottom. This is not a currency, seemingly, that wants to decline. And so we end up with a situation where we have the possibility that the jobs data surprises higher, the possibility that it undermines the case for all these rate cuts, and a dollar that's looking for an excuse, seemingly. And if rate cut bets get diluted, then it's got that excuse. So the way I'm positioned here, just to take a look at what I have on, and you can see this in the Tasty Trade follow page where all of these positions are posted. So I'm long the dollar here. So you can see I'm short the Aussie, short the pound, short the euro, short the Canadian dollar. I have a long-standing long position. You can see it's got until the end of the year in Brazilian stocks. That's more of a thematic thing, but not surprisingly, I'm short some puts in gold, short a vertical here with the breakout. But the core of the idea here is this. So some puts in the NASDAQ, some put verticals in the S&P, some negative exposure in Bitcoin, basically looking for that to be a sort of leveraged risk-off move and a move reflecting strength in the dollar, so tilting the boat even more that way. But long the long end, again, via verticals here with still a little bit of time left. I've been sitting on these things for 60 days already, but I still have them. You can see here we have calls at 86 and 87 with the vertical cap around 95. And the idea here is if you dilute the case for rate cuts now, perhaps more of them migrate down curve. And the long end actually sees yields go down as a consequence of fewer rate cuts occurring nearer term and the market's getting disappointed. So stocks lower, Bitcoin lower, gold is a structural move that probably doesn't care all that much. It's been surging this week despite strength in the dollar, and that's seemingly disconnected from the narrative. So just looking at the price action there with plenty of duration at 43 days, but otherwise betting on a higher number that gets the markets in a bad way. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
All right, so the X date on a stock, what does that mean?
The X date for a stock refers to the X dividend date, which refers to the dividend of that stock. So if you have a short in the money call and the extrinsic value is less than the implied dividend, then you would be at heightened assignment risk. So the X dividend date is something you want to make sure that you are aware of so that you can either roll or close that position to avoid that extra assignment risk. What does it mean when you hear the term pin risk?
So pin risk refers to options that are usually on a round number and the risk of a pin at the end of the day or the end of the expiration for that underlying. So this typically is applied to SPX or very liquid underlyings that have monthly or weekly expirations where the stock price or the ETF price or the index price is right at an even number where a lot of volume and open interest is.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
My most controversial market opinion is it's probably more political.
What's your most controversial market opinion right now?
My most controversial market opinion is that I shouldn't be following Mike and Nick. Just kidding. Love you guys so much.
The hottest take of this market? I gotta think about that. I don't know. I do like to trade the leverage, but that's not controversial. I don't know what controversy means these days. Like, I don't know. I'm sitting on cash. Like, I'm still sitting on a lot of cash, and I think that's generally seen as like frowned upon, but like I'm still doing it. I know market's been bouncing back up. I know things have been looking clear, but no, trust issues.
I honestly don't know if I have one. I'll say the fact that I like to trade earnings or direction as opposed to vol.
My most controversial market opinion is it's probably more political than it is anything else. So, I would say that, unlike others, I think the current political environment in this country is dangerous for the long term.
Welcome back to Risk of the Week. It's been a pretty volatile day. We've been bought straight back up since the sell-off, and then we got NFP to worry about tomorrow. Before we get into all of that, Gus, my brother, how are we doing today?
Doing good. It's kickoff of the NFL season. One of the best days of the year for me. I mean, not as good as opening Sunday, I suppose, but I got my Bengals gear on. I'm here repping, and it's exciting times.
I gotta say, every time
not a good day in the market. I will add that, but the vibes are too high.
I don't know. We had such a massive rally later into the day, and I would have thought things would have reacted a little bit differently because of that. But before we get into that, the Bengals. I seen the Bengals today on the chest, and I was like, this guy's a Bengals fan. I forget. It throws me off every single time, but I can respect it. Ocho Cinco.
Yeah, Ocho Cinco. That's a good pull. Yeah. What you know about TJ Hushmanzada?
Oh, that's my guy. It's like TJ. Got him on.
But yes, Bengals and Reds for me. Cincy teams, as far as Cincy teams extend, and I will also add that if Cincinnati gets teams in other leagues, they will override my existing fandoms in other leagues. But right now, it's just MLB, NFL. So Reds, Bengals. Rockets when I moved to Houston. Predators NHL. I was born in Nashville. I got a claim to them, and I've never lived in an NHL city until now.
You were in Nashville for how long?
Until I was 4.
Okay.
Yeah. But yeah, moved to 2 non-NHL cities, and then I kind of got into it in like high school and college, and so I just clung on to Nashville. That was what I had to tie
by the
to.
bell. You could have been a Titans.
Yeah, exactly. I was a passive Titans fan for a little while. My parents were big fans, but I've settled in with the Bengals. But yeah, we look. I don't know. The defense has got some question marks, as has been the case the past few years. But we'll see.
Hey, on the football talk, real quick. Saquon Barkley. He's an investor, right?
Yeah.
You learned a couple things about him.
We did, yes. Errol and I, I stumbled into some research today that led Errol and I going down a Saquon Barkley investment rabbit hole. You guys can Google it for more detailed information, but the dude is a financial mastermind. His rookie deal was $32.1 million up front. He put all of it into the S&P 500 and said that for his first year in the NFL, he was just going to live off of his endorsements. So that's something like 4 or 5 years ago now. That's been growing nicely this entire time, that $32 million. The next year, he got $10 million in cash, and he put all of it into Bitcoin at 32,000, which was a very smart play. And then the following year, he put 500,000 into Anthropic as an angel investor. That investment is now 20x'd, and he's an angel investor in like 6 or 7 other companies as well. 3 of them have already 10x'd his investment. So yeah, Saquon Barkley, Eagles running back, real financial guru, and it's really refreshing to see. And I feel like that's growing in prominence. These guys like really caring about their money and doing, managing their finances the correct way. I suppose you got Tyreek Hill, who has I think 12 kids with 10 different women now.
Oh, is that what it is?
Yeah, he keeps.
Young boy never. I thought that was young boy. We were talking about for a second. You don't even know.
I'm gonna fact check this because I don't want to speak ill on the man, but he has numerous children.
No, I love it though. Right, one of the top athletes.
This article literally says At least 10 children.
At least. Okay.
Figures range between 7 and 12 confirmed children, with more speculated. So yeah, that's not a very financially savvy move there. But this is a growing trend that these guys are really trying to manage their money correctly and genuinely, build generational wealth, not just live lavishly for the rest of their lives. And so, yeah, I think it's really refreshing to see. Somebody tell Saquon Barkley he needs to be watching tastylive.
Yeah, no, I mean, I love that, especially because Saquon is one of the top, if not the top athlete right now. Saquon Barkley, I mean, with this spin, I don't even know what you call it, spin jump behind the back, whatever you want to call it. I mean, he made the NFL cover.
Yeah.
So a lot of young people are going to see that cover, a lot of these younger people, and they might get inspired by him, start looking into him a little bit more. Oh, yo, he's financially savvy too. And that goes a long way.
Yeah, he's a star, and that's absolutely the types of role models that you want these kids to have. You don't want you don't need to be clubbing and
you don't need young boy all the time.
mansions
Young boy's music is fire. You don't need all the young boys.
Yeah, exactly. I like Green Dot in the gym as much as the next guy.
I'm not gonna lie, you're so valid for your music taste. Every time it catches me off guard, I'm like, Gus is valid. But anyways,
thank you. Oh, big deal. You're a Titans fan. Good to hear. I would still say the Titans are like my second team. Like if the Bengals were ever in a situation where they were eliminated and the Titans were still around, that's who I would switch to rooting for. And I'll tell you what, I'm higher on the Titans than most this year. I think they got a chance to sneak into the playoffs. I like Cam Ward more and more the more that I hear from him. And I do have a Titans to make the playoffs future at something like 4 or 5 to 1. But I think the Titans could be a surprise this year. I don't think they're going to be contenders, but I think they could be a surprise.
So they're not good enough.
It's like, well, there's levels to progression. When you're rebuilding, there's levels to it. So you gotta take the wins where you can get them. But anyway,
American Eagle.
American Eagle.
We got a new slide for today. We can go ahead and jump into the slides.
Yes, American Eagle. We might as well be sponsored by American Eagle at this point, but we just gotta keep talking about them because they will not be quiet. The run only continues for American Eagle. They had earnings. Was it last night post-market or this morning pre-market?
Let me
Irrelevant. Between when the market closed yesterday and when it opened today, American Eagle had earnings, and they reported incredibly strong numbers. So yeah, we can jump into this here. Huge gap up, and this is incredibly interesting. And we'll get into the nuance here, but this is incredibly interesting because this earnings call proved that the Sydney Sweeney thing worked. This is putting into the actual finances and numbers something quantifiable that this actually works. There was these run-ups on hype on these great ad campaigns and all this, but none of that is actually substantiated. And we talked about how crazy it is that a company could move up. What was it on the Sydney Sweeney thing? Like 17% on.
It was 25 to 30.
Yeah.
25 to 33%. You're talking about last night or before the bell today?
No, I'm talking about like
the previous one
when the Sydney Sweeney thing originally dropped.
Yeah, that one was a little smaller, like 8. I think
it was like 1150 up to 13,
somewhere around
like that. So yeah, like a 10-ish% move, just from an ad campaign, and that's really, really interesting to see that they held on to those gains.
Yeah.
Until this earnings call, because usually the hype cycle is exactly that, a cycle. It gets hyped up, we get the run up, and then things fall right back off. But that has not been the case with American Eagle. So just to quickly recap the timeline, Sydney Sweeney has Great Jeans campaign in July. We covered that here on air. Stock moved up about 10% shortly after launch. There was all kinds of backlash, but really the backlash wound up working out in a very positive way for them. They spun the, there's no such thing as bad publicity sort of mantra into absolute truth.
I think they played it perfectly.
Yeah, I don't think they could have done a better job, and I think it was really smart of them to double down on it when they did. We talked about it. If you're in a controversy, either double down or stay quiet.
Right.
But you cannot apologize.
I think people are learning. Like, I think marketing, when you have the masses' attention, is beginning to become more of a skill everybody's more aware about. Again, Cracker Barrel, again, I feel like we keep talking about the same type of topics, just a different underlying. But I mean, Cracker Barrel, again, they got a lot of the heat, they got a lot of attention, bad publicity, good publicity, whatever it is, and then they made a move that ended up capitalizing on that attention. American Eagle, I mean, they had to foster, we were just talking about Taylor Swift's husband the other day.
Taylor Swift's fiance?
Taylor Swift's fiance the other day, and that was with American Eagle too. They've really just been riding this wave ever since they dropped Sydney Sweeney.
Yes, absolutely. It's a legacy marketing run.
Legacy
and they have managed to turn it into actual tangible results. Like we just said, they beat their EPS they beat consensus estimates for EPS by 112% in this earnings call that just happened, which is very uncharacteristic, especially for a company that is as I shouldn't say as public, they're all public, but as established and, rounded and has been in the market as long as American Eagle has, you seldom see triple-digit surprise EPS beats from companies like that. The market has reacted accordingly and moved up another, 25 to 33% today. On the news, you can see the chart here, which Errol so wonderfully removed the background.
Bro, I was looking at this again, and I was like, yo, look at that white background chart. It's fire. I was just looking at it.
Yeah. It's really interesting. And I've honestly never seen anything like it. And
Were you surprised, though? I got to ask.
Was I surprised by this earnings call?
Yeah. Were you surprised by the jump, the velocity?
I'm not surprised that it was a beat. That's what I was expecting, and I was expecting these numbers to be really good and the stock to maybe move up a little bit more. Like, I did think that this was going to substantiate, but to this degree, no. I was not expecting this.
Yeah.
I mean, 112%, and they beat revenue by something like 20 or 30%.
No, I mean, they gapped up and kept running.
Yes. And that's the craziest part, is they gapped up just on the ad before we even knew anything, held the gains, gapped up again just on the next ad before we knew anything, held the gains again, and now we've made another leg up. I mean, I don't know the last time that in this short of a time, in 2 months, someone has managed to kind of surge back into relevancy this hard, add this much to their market cap, save for the Palantirs and Nvidias of the world and occasional penny stock. But to get a legitimate, substantiated move that seems like it's going to hold to this degree, I don't know if I've ever seen anything like it. And it's all because of marketing. They didn't release a new product. I mean, I guess they released Travis Kelce's clothing line as a part of that, but it's not like they've revolutionized clothing here. They just had excellent marketing.
Yeah. No, I think American Eagle is going to be kind of a nice, fun post-earnings kind of idea / play heading into tomorrow and the rest of the week.
But and Macy's had a good earnings report in chat as well. I guess good day for the clothing manufacturer.
What is the what's the ticker for Macy's again? M. There we go.
They've been around.
They've been around.
They got one of the 26 single-digit tickers.
We can go ahead and jump over to the platform here, and we'll do a little tour to market, a little rundown, see what we're looking at ahead of NFP tomorrow. The market volatility just absolutely collapsed today. It was just dead midday. So some American Eagles earnings spicing it up a little bit here.
Yeah, and I think you make a great point too with the fact that marketing is just getting more savvy. I saw something recently, and I think this is so brilliant.
What was that?
Hershey's is doing a campaign right now to promote women. I don't really know a better way to phrase it than that. They're doing a pro-women campaign, and so they're selling.
All right, go ahead. Keep going.
Google Hershey's women campaign.
Yeah, I got to.
But the tagline of the campaign is "Celebrate She." And on the Hershey bars that they're selling as part of this campaign, she in the middle of the bar, like the SHE, is highlighted in yellow or blue, and it's like very prominent.
Oh, I see. I just see it right now.
Celebrate She. Cool. And I saw somebody post this the other day, and here's where I think this gets brilliant. I saw somebody post it the other day and say, Hershey's is so stupid. Her is right at the front of the word. Celebrate her. It would have worked so well. Why would they choose she? And I think that Hershey's is rage baiting.
Yes, the rage baiting tactics.
I think that this is calculated rage baiting from Hershey's, and that they knew that people would see that and get mad and tweet it exactly like the tweet I saw today. And I think that is so brilliant.
Yeah,
I'm blown away. And I think it's amazing these companies, these huge publicly listed companies, are actually getting smart enough and savvy enough to rage bait.
Wow,
it's like
we came to the day, so now we're using psychology in our marketing. Wow.
Yes, and it worked. And I'll tell you what, I went scrolling through those replies, and not one person pointed this out. Everybody just said, "Oh yeah, it's right there, Hershey. So they're so stupid." Oh, that picture never hits Twitter if it's her. No. You would just brush right over it. It's brilliant. It's brilliant. So I think that's great. Yeah, I mean the rage bait. It just works. I'll float this. I told Errol ahead of time. I posted a TikTok the other day with some intentionally slightly shoddy economics with this exact same thesis, and it panned out beautifully. Everyone got mad at my economics in the chat, and the video performed well. This rage bait stuff is real, and I'm not necessarily endorsing it, but it feels like, and especially with a brand like Hershey's shifting over to it, it's almost like this is like a survival tactic at this point. This is what everybody is doing, and I hate it. I will say I don't like it when I see it on social media. It's annoying, and it's becoming too prominent, but it's very effective.
No, it's funny, we were having that conversation earlier today, but to see it done at that scale of company, it's like you're really gonna rage bait your audience.
Yeah, it just works, and especially in the case of Hershey's, like that's just a pure like brand recognition, like get it gnawing at your brain. They just want you to see that on Twitter, and then a little bit later you're thinking, oh, I want something sweet. Oh, I'll have some Hershey's chocolate. Like there's
whatever happened to Bud Light post the fiasco.
But Bud Light itself, the sales haven't quite fully recovered. I think they're still down like 15 to 20% from the peak. However, Anheuser-Busch has taken no hit. They've discontinued.
I was just
to move up.
Okay. I was just curious because I know there was a there was a lot of disagreements with the whole Bud Light commercials and those type of things, and I was just thinking to myself too. I wonder if these big companies, right now, we're starting to catch on to certain rage bait tactics, but companies that were doing it very well beforehand, if they do it well enough, we wouldn't be able to tell that they're doing it.
Yes.
Right. So I wonder if.
Well, and I mean, to that end, the Sydney Sweeney has great genes kind of wound up working out as a rage bait tactic. I don't think that was their plan.
Really, I thought it was.
I
was like, I don't think there was any ill intent, but I thought that they knew as they were making it, they're like, oh, it could be taken for this, but like, this is great marketing.
I don't know. I mean, it's certainly possible, but I don't know. I think that they probably just said, "Oh, geez, this is a great play on words," and like kind of whiffed on it. But I don't know. I mean, also they were quick to stand on business when people called them out. So
they were.
Maybe it was a part of the calculus that they knew they.
I don't think there was ill intent, but I have a hard time not seeing these intelligent individuals at this level didn't know that was a possible scenario that could play out, especially in their profession. But.
How's Hershey looking? Show me HSY.
How's Hershey's looking? How is Hershey's?
HSY is what it is.
HSY.
Yeah, she.
There we go. It's a little quiet right now.
That's all right.
I will say American Eagle, relative to the move that we saw today, it's been pretty quiet, even with the original launch with Sydney Sweeney. I mean, this move is just... I mean, there's really no other way to put it.
Well, and almost always when you see this, like, gap up from earnings like this, you will see downward action the next day. But that's not what happened here. We actually just wound up getting more bull side action, and the bulls are keeping this thing propped up, going towards 19. This is fascinating to me. I mean, whoever American Eagle, you better triple, quadruple your head of marketing salary, because this is insane.
Oh yeah.
I mean, we're talking about a 12 into 19 move.
Yeah, it's almost 100% move.
Yeah.
American Eagle in less than 3 months. That's nuts. But with all that being said, we got a few things in the portfolio. We got to make some decisions on what we're going to manage tomorrow. Luis, my guy, how we doing? Good to see you. We got some gold. We're short a little bit of gold. Gold's been going on an absolute tear, but we sold an out-of-the-money call spread. Luis, we're short some gold, brother. We'll see how this goes. 43 days till expiration. We need to be a little patient on it. Then we got Google. I know we've got some Google call spreads on. I feel like there's a handful of us. I think there's about half of us that has some short delta on in Google.
Yeah, I'm short.
Are you short Google right now too? Yeah. Sold an out-of-the-money call spread on Google. 43 days left till expiration. NVIDIA, this one's kind of hasn't been doing too much. 43 days left till expiration. Out-of-the-money call spread. QQQ, down a little bit on the day-to-day after that insane rally. 43 days left till expiration. RKT, get that out my face. We got 15 days left till expiration. One of the risks of the week that we had put it on a few weeks back. I think it was one of the smaller cap stocks we were looking at. And then SPY. We had another rally today, sold an out-of-the-money call spread, sold the 640 calls, bought the 645. I got about, 274 on there, so I got maybe $225 worth of risk. 15 days left. Maybe we get a sell-off into tomorrow. I don't know. I'm curious about NFP. And, I think we're going to end up cutting rates. You have any thoughts on cutting rates? I think it's kind of inevitable at this point. But because we've been raising rates for so long, I think once we start cutting rates, we'll finally be in a different market environment, which could potentially lead to maybe, hopefully, higher premiums, maybe some higher volatility. It's just been quiet, that's all.
Yeah.
It's been really quiet. I've been waiting for that pop on VIX. That's what I'm waiting for.
Yeah, I agree. I'm also expecting a rate cut is my short answer there.
I mean, I feel like that's going to...
I think we might get 50 before the end of the year, like cumulative. I think that's within reason. I mean, it feels like this thing is like a bomb. And it does. This pressure is slowly building up on the rate cut, and it feels like we're about time for it to explode.
It's about to be 2026, but it's felt like I've been waiting for that pullback or that whatever. Guys, what are we waiting for? Ever since 2020.
I'm not waiting for anything. I'm long delta to the freaking moon.
Bro, I can't. I mean, like even in 2022, 2023, it's like, really? Are we really gonna go higher? Goes higher. Are we really? Goes higher. So I don't know. This time feels different. And those are the famous last words.
I was gonna say that's like definition of insanity right there. Just the same thing over and over and expecting a different result. Yeah, no. And I will say this Google thing too. I really, really don't understand this move out of Google. I sort of went on a tangent to you earlier today. This Google thing. 2 months ago, maybe 1 month ago, Google was sliding for a prolonged period because of concerns about AI eating up all of their search engine revenue. And now they get to keep their search engine, and so they go up 10%. It doesn't make any sense to me. I don't get it. Are we worried about Google's search engine revenue or not? I sure as hell am. I will tell you that. I don't know. I mean, my Google search usage is, cratered this year. I seldom will search something on Google unless it's really, really quick, low-hanging fruit. But yeah, it's just like I don't get it. And I think that their search engine revenue is only going to continue to fall apart, especially with how just terrible their AI is. I can't believe that Gemini, the built-in Gemini on Google, is not even remotely near ChatGPT now. It's so odd to me. Like earlier today, for instance, in the middle of the day today, Amari Cooper of the Raiders retired, which was gigantic breaking news as he just signed with the Raiders a week ago, and the season for the Raiders starts on Sunday. So he was gonna be like their wide receiver 1, wide receiver 2. So he suddenly retires today. I Google to verify, did Amari Cooper retire? First thing that pops up on Google AI summary. No, Amari Cooper did not retire. Immediately below that, as soon as the AI summary ends, is a tweet from Schefter saying, breaking, Amari Cooper has announced his retirement. What? How are you not catching that? How are you providing me the correct results, but the AI can't do it? It doesn't make any sense to me. And even, it really threw me off because the AI said, no, Amari Cooper's not retiring. This was part of an August 2025 hoax. And then right below it is Schefter saying, oh, Amari Cooper's retiring. So Google has got to get on the ball with that. I don't know how that thing is still so.
I don't know how Google didn't I now see Lone talking about, OpenAI would have, purchased Chrome, but Google is such a massive company. I'm not going to call it a monopoly, but just to give you the sense of how massive of a company it is, I'm surprised they're not a little bit more ahead on the curve.
Well, yeah.
And they're focused on search engines.
I agree, yes, because they could have clung on to it if there was as good and intuitive as responses right away as there is with ChatGPT, but it's just not there at all.
Yeah.
Yes, I agree. OpenAI probably would have made a move to purchase Chrome. And yeah, like you said, Google is enormous. They have revenue streams coming in from everywhere. People forget that they own, YouTube, they own Waymo, they have a messaging service too, no?
For Google?
Yeah.
Outside of email, like
Facebook has WhatsApp, but I feel like there's
WhatsApp, Google.
I feel like Google has one of those in their bag too.
They probably do. It's one of those things where it's like, oh yeah, forget Google owns this too.
Yeah. But it's just I don't understand this move at all, and I'm worried. I definitely think that their search engine revenue is going to be cannibalized. If you look at AI usage market share right now, Gemini is consistently at the bottom of that barrel.
Yeah.
That's ChatGPT.
I forget about Gemini.
Cloud is like the next.
I did see somebody using Gemini today to help edit one of their photos. I did see that. I was like, in my head, I was like, oh, Gemini, really? That's the preferred AI
I actually
model?
happened to be on Google CEO's Twitter earliher today, and I saw him posting about the new Gemini 2.5 photo thing.
It's like, bro, nobody's listening, bro.
Yeah.
Go ahead, delete that tweet.
Yeah. Go ahead,
delete that tweet, bro.
Pull that down for me, champ.
Delete that tweet, little bro.
It's just a retweet of somebody else's tweet, actually.
Oh, okay.
That guy's name, Sundar, who's his first name. I can't think of his last name.
Lastly, before we start to wrap here, one thing that's really interesting too with a lot of these tech CEOs is typically a lot of the tech CEOs, you didn't really know the face of them. Typically, the tech guys are usually a lot of the time behind the scenes, and they like to be that way. But nowadays, it's a lot different too. Like with Sam Altman, I was watching a podcast with him the other day, and somebody had made a comment in the comments section that really opened my eyes to these tech CEOs are building personal brands and having their own face and personality to market their companies, right?
Well,
and I feel like Elon Musk kind of led that just a little bit, because I feel even at that realm of individuals, it's like once somebody starts doing it, then the other ones will be like, oh, cool, I'll start doing it too.
Well, I don't know. I would argue that I think that that's always been around, and it's a founder thing is what it is. Because Jobs was certainly very, you knew Jobs' face. Bill Gates is the same way.
Yeah.
You knew their face. They were constantly doing these big, keynote speeches and presentations for their new products and things. You knew what they looked like. But I do think that is increasing in prominence. You see it with Jensen Huang too at NVIDIA. He's similarly public facing and prominent. But often you lose that when it gets switched out. But I don't know. I feel like Tim Cook is still recognizable.
It's one of the things I've never seen Jobs or Tim Cook on a podcast or a relevant podcast that Gen Z's watching, whatever the case might be. So I think the approach of, interacting with the public is a new thing that a lot of these big CEOs are, kind of starting to do and get in touch with.
Remember, pick that penny up. It's true. It's true. Shouldn't pick up pennies in front of a steamroller.
No.
I'll tell you that, though. I'm not even sure exactly what this is about. Did we say something funny?
I know.
Are we funny? Is this us?
I don't know what that was. No, but we got a couple minutes left here. Anything else to add on the way out? We got some volatility coming in tomorrow.
Yeah, I'm trying to think if there's anything else that's on my immediate watch list here. How about Rivian? Let me complain about Rivian for the last 2 minutes.
Go ahead, get on your soapbox.
Rivian, man, can you pull it up for me? Rivian, this thing. Lock in. Rivian is the king of making gains and then just giving them right back. And it's frustrating the hell out of me. I have been long Rivian for so long. I have naked call leaps and I want them. I want to liquidate them. And I've had numerous times where they are very profitable. But Rivian, man, this thing, every time it goes, I mean, it will rip for a day. It'll do 20% in a day and then give it all right back the next day. I've never seen anything like it. It's crazy. This thing cannot hold its gains. Yesterday, Rivian gets a $5.8 billion with a B dollar investment from Volkswagen. They also announced that they're going to start letting people get into the Rivians with their iPhone or Apple Watch. Apple Key, I think is what it's called. All good news. It rips accordingly. And then today, everyone's just like, never mind.
I'm good.
I'm out. Why?
Good.
Why, guys? Don't sell it. Keep holding your Rivian, please.
Hey, it's either buy low, sell high, buy high, sell higher. There we go.
Sell higher is right. I saw somebody took a $4 million sweep of Google 250 calls today.
Google 250 calls.
Yeah. So
what does he know that we don't know?
I said the same thing.
Because I might have sold that to him.
Yeah, shout out to Chase for texting me that information. He
definitely sold those calls to him.
He shot me those sweeps earlier today, and it made me feel a little worse about my Google long position. To be fair, Google did have another good day today. So
valid.
This is why I don't get short, Errol. Fuck.
hey man, we gotta throw a little bit of short delta every now and then. Now, anything else to add before we hop out?
Nope, that's all I got.
Cool. We'll see how this pans out. American Eagle tomorrow, see if they can hold their gains. And then NFP tomorrow. I'm really excited for that. Maybe we get more volatility into the market. I'm not praying on the downfall.
You are.
But I absolutely am. And if we get it, it's going to be nice if we do get the short. I'm not going to lie, the way things are adding up right now. But anyways, that's going to do it for today's segment. Be sure to tune into us again next Tuesday and Thursday at 4:30 Central Time. Be sure to stay tuned for more segments coming on next. We'll catch you guys later. Peace.